Okay, after looking at the performance at the time of origination, we also need to look at the long-term performance of those new accounts. We need to remember that credit business is a long cycle business, and that means you can only see the effects in a fairly long term. Typically, for loss, it begins to emerge after 7-8 months. So that means really after 12 to 24 months, you can begin to see the credit quality as well as the profit of those originated accounts. Okay. First, let's look at what's the origination vintage. Vintage, if you are wine drinker, you are familiar with the idea. If the wine is vintage 2018, that means it's made of grapes harvested in the year for 2018. So very similar idea. Origination vintage refers to accounts originated in a particular time period. For example, if a group of accounts they were originated in January 2020, then they can be referred as the monthly vintage of January 2020. Similarly, for those accounts originated in January to March 2020, they can be referred as the Q1 2020 vintage. So it's a quarterly vintage. For all the accounts originated in the year of 2020, they can be referred as a year 2020 vintage. So it's a yearly vintage. Okay, so the performance matrix for vintage reports typically are delinquency vintage curves and the charge-off vintage curves. Eventually, the loss will be captured in charge-off, but often we do not want to wait for 6-7 months to see the charge-off. We want to know the information early on, so we need to monitor delinquency. In addition to charge-off.